This is Andrew Stotz of Stotz Investment Research, and I'm going to talk today about 9 valuation mistakes and how to avoid them. Well, I'm not actually going to talk about 9. I'm going to talk about the first one. So let's get into it. First of all, a little background on myself. I had a career as an equity analyst for 20 years. I was the head of research for many of those years, also managed teams of analysts, wrote lots of strategy and company reports. I was voted the #1 analyst in Thailand 2 years, and I started the Valuation Masterclass in 2017. And in that Valuation Masterclass, I was able to watch the mistakes and the errors that analysts made and upcoming people made when they were doing valuation. I decided to take all that I learned from that and from my own experience and bring it together for this presentation. But let me tell you a story. You see that fire? Gather around the campfire. Here's a story. Now, many years ago when I was a bank analyst, my boss asked me, "Hey, Stotz, what's your earnings forecast for next year for Bangkok Bank?" He was on the phone with a client, and there's a picture of me. You see that one? That was me at that time. I used to have more hair on my head than I have now. And those are my nieces who are sitting around me. So my boss was talking to the client. The client was asking for the answer, and I told my boss, "I don't have it. I need to go back into my spreadsheet." And this is actually a copy of the page of my spreadsheet from about 15 years ago, where I was looking at the assumptions related to the banks, Bangkok Bank, and all the other banks in Thailand, where I was at the time. And from that, my boss came back after about an hour and asked me, "Hey, you got it?" And I said, "I don't have it yet." He said, came back another hour later, "You got it, Stotz?" I said, "I don't have it yet." And then at the end of the day, he's like, "You got it?" And I was like, "I need more time." So the next day I came in and he's like, "You have it?" I was like, "I need more time. I'm trying to get it perfect. I've got to look at all the banks and Bangkok Bank to get the right one." And then after that, he was really annoyed. Eventually, he came to see me. He says, "You got it?" I said, "I got it." And it was 9.73. I was pretty impressed with myself. And my boss said to me, "Well, that's great, because when I was talking to the client, I told them about 10%. That was my first lesson in understanding that all the effort that I was making to try to make it perfect actually just made me really, really late and not so helpful to the client. What do you think is an accurate earnings forecast? That's a question I asked for my dissertation for my PhD. In fact, here it is right there. I did it at a Chinese university, and that's my PhD, and it's an empirical study of financial analysts' earnings forecast accuracy. Of course, that's an academic way of saying how accurate were analysts. So maybe 10, 20, 30%? What's the right answer? Well, the whole complete PhD comes down to this one chart. And what this shows is that the best years, analysts were only wrong by about 10%. So you can see the yellow line at just below 10% in 2004. And what we can see is the worst year was 2008, and they were wrong by 55%. And they were never pessimistically wrong. They were always optimistically wrong. Now, what does this mean? This chart shows us on average about 25% error in analyst forecasts globally. That means that the analysts are forecasting 125, but the company actually produces 100. So from this, we can see that analysts tend to be optimistically wrong. So that's a lesson right there in this one chapter, to think about the fact that always adjust down your forecast or the forecasts of an analyst. In fact, whenever I teach university students, I always teach them YAAW, YAAW. What does it mean? You are always wrong. What do I mean by that? What I mean is that in finance and in forecasting and valuation, it's an art, not a science. So therefore, we're never going to be perfect in our valuations. So accept that, and then think about valuation more from a perspective of it's a lever, it's a measure, it's a way of trying to understand what are the factors that drive value in this company. Now, let's talk about the way I do things. I use something I call value model. It's the model that I created, and I actually even sell it to banks and brokers. But what's different about this model? Well, first of all, you can see that in the trade-off between simplicity and precision, I choose simplicity. I use a standard model rather than creating a new model for every company, and that allows me to hone in very quickly. I like to always ask the question, how much are you being paid for doing your valuation? Hey, if it's $10,000, fantastic. Build a customized model, do all of that. But if you're only being paid $50, hey, keep it simple. So I've developed this framework over more than 2 decades in my work as an analyst and as a head of research and, of course, as a teacher. So it's a simple yet complete framework to value any company in the world. And so I have research teams on both the buy and the sell side that use it as a subscription service. And I also teach this to my students in the Valuation Masterclass. So let's get into this top 9 valuation mistakes. I'm going to give them to you now, but we're going to talk about number 1. Number 1 is overly optimistic revenue forecast. Number 2 is underestimating expenses, causing unrealistic profit forecasts. Number 3 is growing fixed assets slower than revenue. Number 4 is confusing growth with maintenance CapEx. Number 5 is forecasting drastic changes in cash conversion cycle. We know that's unrealistic if you're running a business. Then number 6 is underestimating working capital investment. Number 7 is valuing a stock using the calculated beta. Number 8 is choosing an unrealistic cost of equity. And number 9 is not properly fading the return on invested capital. So let's get into it and talk about number 1. Analysts make overly optimistic revenue growth forecasts. And here you have a screenshot from my value model looking at a company, and you can see that in the historic periods, it was minus 2.5% revenue growth, then 0.6% revenue growth, and then the analysts forecast 20, 25, 30, 35. Way overly optimistic. Let's look at this in a little bit more detail about this. Why is this important? Revenue is the most important item in valuation. Revenue research, of course, happens outside of the office. Get out of an Excel spreadsheet to do this. Some critical questions you're going to want to ask. How many salespeople? How many people are on the sales team? Who's running the sales team? What are the constraints to sales growth? What's the company's growth plan? Oh, hey, look at that funny picture. That's Alex. He put in that picture. That's not actually him, but Alex and I work together, and he put in this picture to remind us about something. Now, think about it. The S&P 500 will gain 30% this year since it was up 20% last year and 10% the year before. Think about somebody who says something like that. And what you're going to find is that they usually are suffering from recency bias, and you do too. So be careful. This is when you believe that what has happened recently will continue to be the case. You'll stay in stocks because it's a bull market, even though you acknowledge the high valuation. Or when making decisions about the future, don't use yesterday as your only reference point. Now let's look at this chart right here. I've pulled together all the companies in Asia, the top 500 companies. I've pulled together their revenue forecasts or their revenue numbers, and I've been able to see that the peak of revenue was in 2013 at about 2.5 trillion US dollars. And if you were an analyst forecasting in the past, you may have gone to look at this and said, well, if I was forecasting in 2007, 2008, I'd probably forecast like that. Then what about if it was 2009? I'd forecast like that, or like that, or like that, or like that. The point is that we tend to forecast what's actually been happening recently. So be very careful of this recency bias. Now, I want you to avoid overestimating revenue growth. First, you've got to consider the products of the company. You've got to consider the marketing, the branding, the products and service, the selling process, the delivery, and after-sales service. All of these things. Let's take a look at marketing. Is the company's market share rising? Has the management team completed a thorough market analysis? How well do they understand the competitive landscape? You see, you can't understand these things by sitting in a spreadsheet. You've got to get out and look at the company. Has the management team determined the attractiveness of markets and segments? What about the size, the trends, the growth, the profitability, all of these factors? Does the management team understand the needs and wants of these segments? This is how we understand, can they capture growth in the future? Has the company identified its target market within each segment? Looking at the location or the age, the gender, does the company understand the pain it solves within each segment? Look at branding. Does the brand clearly articulate what the company provides to the market? Think about the master brand communicators like Amazon or Apple, Coke, Disney. Come on, everybody knows what Disney delivers. So when you think about this product or this company, how would the company stand out if it was competing against Disney? Would its message be clear? Let's also look at branding and understand, does the company understand and articulate the core brand benefit with emotion for each segment? In a few words, don't you just love it? I love Nike. Just do it. Now, I don't have Nike shoes, but I love their saying. It's got power. Is the company's brand personality and story simple and built into all communications? Also, can employees and existing or potential customers state the value the company represents? Is this verified through audits? How do we know? You've got to ask these questions. Does the company deliver what the brand promises? Let's look at the products. What are the existing products? And what about growth profiles of those products? Where does company have product gaps relative to competitors? Are there plans to launch new products in future? One of the companies that I happen to invest in as a private investor with my best friend Dale is my coffee company, Coffee Works. And I've always been an investor in it. Dale runs the business, but we have a new product, and that's cold brew nitro coffee. Man, this stuff is great. And the profit margin is higher than the profit margin we get in other parts of our business. So how could we expand that product into our business and increase the profit margin, the gross margin of our business over time? This is the type of questions that we need to understand if we're going to correctly forecast revenue. Now, what about the selling process? How systemized is the company's selling process? You know, when I was an analyst, I just sat behind my computer most of the time. I didn't get these things until I got older. And as you get older, you want to understand the ideas. What's the efficiency of the sales team? What's the plans to build it? How long is the company's sales cycle? Can it reduce that cycle? All of these questions. What's the bottlenecks in the sales process? Is the revenue scalable? And then look at after-sales service. Is the service delivered on time and congruent with the branding? Buy the products. See how they deliver. Is there good follow-up with existing customers? Are existing clients offered a valuable upsell, higher value products to increase the average revenue per customer, or we also call it ARPU, right? Does the company know its level of customer satisfaction? Are the numbers legitimate? That's a good question. And what are the company's reorder rates? Now, those are the concepts of the questions that you need to ask to make sure you don't make the mistake of overestimating revenue forecasts. But I'm going to take you into some recent academic research that I've done on revenue forecasts. So let's go into this. The first thing is my academic style research follows the following structure. We ask a question, we summarize previous research, formulate a hypothesis to test, select a relevant data set, remove errors and outliers. That's a whole nother subject that's a very important one. Formulate a methodology to test the hypothesis, present and analyze the results, and then most importantly, advise on how to apply to improve investment decisions. What you'll see if you are a student in studying a PhD or you want to study a PhD, that's the format you use to write your dissertation or any academic paper. So what's the question? How accurate are analyst forecasts, revenue forecasts in Asia? You see that little rat with a little syringe in it? That means we're talking about some research. Luckily, finance research doesn't require us to hurt rats or monkeys or humans, right? So I looked at a universe of Asia, including Japan, but excluding India. You want to know why? Just leave a message and I'll answer that question. But to be included, the company had to have 10 years of actual data. There must be at least 10 analysts covering the company. The result was 540 of the largest companies in Asia. So I'm not trying to look at every company. I'm trying to say, what about the big companies covered by lots of analysts? I want to understand more about these. In particular, what is the success in analysts in their forward 1 year forecasts? And here are the results from what you can see. The percent absolute deviation in 1 year ahead revenue forecast compared to the actual outcome is what the red bar is. And from it, we can see also the number of analysts. There's more analysts covering these companies right now. On the right-hand scale, we can see there's about 16 analysts since about 2011 covering these companies. And the conclusion that we can see is on average over the period, analysts were in error. This is absolute error, not above or below, just error. And on average, it was about 10%. And what we can see also is it seems like it's getting more accurate, but that can be deceiving. Usually it gets more accurate when things are really stable, and then things blow up. And when that happens, things get a mess. Now, I haven't calculated the actual error from a above or below perspective. This is just absolute error. So what I would say is I would estimate in this case that analysts were about 15% overly optimistic in their revenue forecasts. Now, consensus can't predict revenue for cyclical sectors. It's easier for non-cyclicals. You can see right here that I'm classifying companies by trying to understand their sectors and the success of analysts. If the bar is high, it means that the analysts are inaccurate, as in the energy sector where there's 17 companies in my universe. And on telecoms is where they've been very good. Well, it's a very stable industry or sector. So we can get an idea from that and we can see the accuracy. Let's look at a couple of case studies. One error I saw was PTT, a company in the energy and utilities sector in Thailand, and the analyst was expecting revenue to be very strong. But what the analyst missed was that the actual revenue forecast revenue result came in dramatically below their estimate. And why was that? Well, the problem was the analyst was not forecasting the macro trend related to the NGV price. And so as a result, the analyst got it wrong. So there you go. It's error number one is trying to make sure that you're in touch with the macro trends. That's tough, right? That is very tough. The price of NGV fell for the entire year of 2016. Let's look at another one. BEC is an entertainment company in the media and publishing sector, and the analysts expected sustained weak domestic consumption have continued to dampen BEC's fourth quarter revenue, but we believe that its fiscal year 2016 revenue will rise to 2.8% due to recovery in consumption, and they were so wrong. Instead, what we can see is that the actual result turned out to be negative 22.6%. And why was this? The analysts missed the fact that the company was losing ad revenue from one of its major customers, Unilever, that was moving it more to online and digital formats. Now let's look at another one, which is this company, TSH Resources in Malaysia. It's in the consumer staples sector, and what we can see is the analysts expected them to deliver stronger revenue growth, but what ended up happening was things were tougher than they had expected, and this had to do with the fact that there was nature that came into the situation. El Nino effect impacted the output of this company, and it's very hard for an analyst to capture that. So this is an example where an analyst is going to be hit from left field in such a case. So what have you learned from this? If revenue forecast is wrong, valuation is wrong too. Understand a company's marketing, branding, products and services, selling process, and delivery and after-sales service. Curb your enthusiasm. Now, that summarizes what I have seen in the number one error of overly optimistic revenue forecast. In the next video, check out where I talk about underestimating expenses, which is causing unrealistic profit forecasts. Have a great day, and I'll see you in the next video.